All right, so good evening and welcome to this will be our third lecture. And in this lecture, we are looking at interest and penalties. Interests and penalties. We all know that there is a huge likelihood that some taxpayers may be paying penalties owing to the fact that they flout on regulation. And so what we need to understand is that, first of all, there's a distinction between interest and penalty. They don't mean the same thing. All right, so we need to first outline the difference. Now, when we talk of interest, interest is calculated on an amount. And so when we talk of interest, interest is just a compliance for a breach of the act. Now, herein, the interest is on the money. So interest is calculated on non-payment or short payment of tax as and when due. So interest is done on non-payment, short payment, in other words, delays. So if you delay in this tax payment, then it means you have not paid. So that will be non-paid. All right. And you paid and you short paid. Also, it means there is a part that you have delayed in paying, and therefore there will be interest that is calculated on you. So interest is calculated on the non-payment, all right, or short payment, i.e., you not paying it as and when the thing is due. So that is interest. But when we look at penalty, penalty is a little bit different. Penalty just imposes a breach on you on you deciding not to do your voluntary compliance return. So penalty here is on failure to file your return. So that is that. Failure to find a return as and when due. So any delay that you delay in the penalty, that one to delay in filing, that one to attract a penalty. So these are the dimensions that you need to understand. They are not the same thing. Interest is on the money payment and penalty is on non-filing, i.e. you didn't file at the right time. All right, so basically that is that. Now, we are going to look at the penalty because the penalty, we look at those in the communication industry. All right. And those that are in non-communication. So all the other industries. Communication and non-communication. Now, if you are in the communication industry, like the MTNs and all those people, not radio stations, we are talking about these networks, all right? If you had a filing to do and you didn't do, the first day you didn't do the filing, it is going to cost you a penalty of 2,000. That is what it is. The first day. So let's say today is 13th. Let's say by 15th of this month, you are supposed to file the withholding tax of last month. By 15th of this month, you are supposed to. By the time we enter 16th, if you have not filed it, on 16th, you are liable to pay 2,000. Then any day from that day you fail to file the tax, you will be paying 500 cedis a day. 500 cedis a day. And I'll try and show you how these things work. I will use one of the entities that I do the filings on. I'll try and show you that. So that is that. Then we have the non-communication industries. Now, for the non-communication industry, i.e. normal business, so other than the MTNs and all those people, the first day you fail to file, it will cost you 500 Ghana cedis. Then any day counting from that will now cost you 10 Ghana cedis. So each day will be 10 Ghana cedis, but the very first day will be 500 Ghana cedis. So now let me just show you how these things are in the real world, okay? So basically what I'm saying is that the first day you miss out, 500. Then counting from that, 10 Ghana cedi every day. So that is that. We will look at some small examples. All right. So that is the penalty for non-filing. All right. Now let's come to the interest calculation. Let's come to the interest calculation. So on interest, we will look at from section 70 of the Revenue Administrative Act. So we first look at section 70. Now, section 70 here, as you can see, is on self-assessment, and it is talking about interest for underestimation of income tax payable. So underestimation. Now, one you need to understand is that this underestimation we are talking about is relevant to also underpayment, because what you estimate is what you pay. All right, what you estimate is what you pay. If you remember, in our second lecture of tax administration, we pointed out to the fact that there are two types of assessment. We have the self-assessment, and which one? Which one do you remember? And the CJ's assessment. And the CJ's assessment, if you have learned your notes, you realize that we have 4 types of the CJ assessment. All right, now the self-assessment is when you, the taxpayer, you assess yourself. Now we are talking about self-assessment. You don't assess yourself on final tax. You assess yourself on provisional tax. So what this one means is that as we learned that on the end, by the end of the first quarter, which date is that? First quarter of the year, which date is that?
31st March.
31st March. So let's say if this is 2024, we are in, by 31st of March 2024, you should have filed your self-assessment. And I showed you the last time how you do self-assessment. If this thing had opened, I will just show you except of a self-assessment. Let's see. If it opens, I'll show you the self-assessment form. So in the self-assessment, what you are doing is that you are telling GRA, by this time, you are telling GRA your gross revenue you think you will make. Your gross revenue that you think you make, i.e. what we call chargeable income. So it means you have your revenue, then probably you deduct your cost. And so you tell us that, oh, this is your chargeable income, what you will call profit. This is your chargeable income. Now, if you have your chargeable income, let's say 100,000, then you are going to do the tax applicable. If you are within the 25%, that will be 25,000, right? Now, you tell GRA that you will be paying how much every quarter. So this divide it and give me the answer. So that is how much you are going to pay to GRA every quarter. The first quarter, as you elaborated, is
6,250.
6,250. All right. So the first quarter, 31st March 2024, you pay this. So every quarter, then June, 30th June, you will pay. Then 30th September, you pay. The last one will be 31st December 2024. Now, if you do your assessment of this revenue, it's an estimate. All right, it's an estimate that you did because the year 2024 has not even come to an end. All right, but it is an estimate that you have done. Now, just to prevent some people from estimating a very low amount, because it's a self-assessment, you are leaving it to people. So just to prevent people from setting a low amount as their self-assessment, the GRA law or the Revenue Administrative Act has come up with that interest calculation. And it is saying that according to section 70, it is saying that, look at it, it says that this section applies to taxpayers' estimate or revised estimate of tax payable for the year of assessment. And it says that if it is less than 90% of the correct amount. Now watch this. I'm going to explain it to you so that you can even frame it to your own understanding. Now it says that the taxpayer is then liable to pay an interest of 125% of the statutory rate, compounded monthly, applied to the difference between the 90% of the total amount that would have been paid by way of installments. You see, these are things you should take note of. It didn't say that would have been paid, though. It just said that would have been paid by way of installment during the year of assessment, and the amount of income tax paid, not estimated, paid. So this is the law. And like I always tell you people, if you are reading the law, you don't rush. If you rush with law, you always skip important things. So here, the things that you see in here, that what the law is trying to say is that when you do your estimate, we will be comparing it to a 90% of a correct amount. So you see that this is what will happen. Now watch this. In 2024, this is what you did. You did 10,000, and you are saying that every year 100,000 and 25,000 was the tax payable, and you are saying that every quarter this is what you pay. This is what you will pay. Now, if this is what you say you will pay, did you pay it? That is one thing, because this is an estimate and you have divided it into 4. The next question is that the law never said let's compare it with the estimate. The law said we should compare it to the amount of income tax paid by installment during the year. So now, if you paid this, let's say you paid on each of the quarter, then it means that is what we will be using to do our comparison. Now, there is another element. The laws made mention of the correct amount. What is a correct amount? The correct amount is the actual tax that you are supposed to pay. So by the time you did this one, you were supposed to do this one March. By March, you are supposed to do this. So by the time the year will end, let's say December 2024, and we enter into the new year 2025. So let's say 01/01/2025. But this time, by this time, all right, or per the law, you are supposed to file your final tax on 30th April. You know that, right? We learned that. You are supposed to file your final tax for 2023 by 30th April. All right, by 30th April. So 4 months exceeding the basis period that just left. So if that is the case, what is going to happen is this. By the time we enter into this new year, you can now see your whole profit. Let's assume that by the time you entered into this year, your profit actually was 500,000. By you, what you filed to GRA was 100,000. And let's say you calculate your 25%, what will it be? 25% of the 500,000, what will it be? So this is the actual, and that is seen after the end of the year. Yes, what is 25% of 500,000?
125,000.
125,000. Good. So this is what we call the correct amount. The correct amount. So the correct amount here is the actual tax payable, the actual tax payable, not your estimate, the actual tax payable. So the law says that we are going to compare yours, all right, the one that you did, so to a 90% of this one. So what is 90% of the actual amount or the correct amount? What is 90% of it?
112,500.
112,500. Now, in this case, when we compare the one that you paid by installment during the year and the 90% of this one, then it means you have underpaid. So that is the comparison. Now watch this. This is the money that you should have actually been able to estimate, which you couldn't. So what we're going to do is that we're going to divide this one into 4 also. So when you divide it into 4, what will it be? When you divide it into 4, what will it be?
28,125.
That is huge. 28,125. Is that it?
Yes,
All right.
that's it.
That tells us that every quarter quarter one, you should have been doing 28,125, but you were doing 6,250. And because of that, the law says that we should find the difference between the 28,125 and the one that you have been paying. All right. And this is it. It says that this is it. This section applies to a taxpayer's estimate or a tax of the year, which is less than 90% of the correct amount. The taxpayer is therefore liable to pay an interest as 100 and calculated as 125% of the statutory rate. So the question will always give you the statutory rate or the Bank of Ghana monetary policy rate. So what is the difference between these two? What's the difference? Where's my calculator?
875.
It's how much?
21,875.
Into 1,875. So this difference, we are going to apply 125% of the statutory rate. So let's say the statutory rate is, let's say 25. That will give us something like 20%, right? Check. All right. Then we are going to apply it on this figure, compounded monthly. Now, this is the formula for compounding. A is equal to P into bracket 1 plus R over N raised to the power NT. This is the compounding formula. All right. So we are going to use this one to do the compounding. All right. Now, so that is what, yes.
To be 1.25%.
The rate is what?
31.25%.
It's at 100 and no. 125 of this is what? 125% of 25 is what? 31. This is percentage, oh.
Yes, they are
what
both
do you get?
31.25%.
So this will be 31.25%. All right. So the one they say compounded monthly, this is the formula for compounding. Now let's define the variables in this formula. A is the amount to pay, including the interest. Amount to pay, including the interest. That is A. P is the short payment, the one that we calculated here. The one that you have calculated, that we are doing it on quarterly. So here we call it the underpayment, the quarterly underpayment. 1 is 1. R is the 125% on the statutory rate. So the 31.25 you had for me would have been our R, statutory rate. Then N is the number of times this amount is compounding. So the number of times of compounding in a year, of compounding in a year. And that is always equal to 12 months. So it's always equal to 12. Doesn't change. Then we are left with T. What is T? T is quite tricky. So let me bring it somewhere here. T is very tricky. T is the earlier of these two periods. T is the earlier of, you see, you had 31st March 2024 up to 30th April 2025 for that financial year. You can't go beyond that. So that is the time for you to do your filing for the thing. So it is the earlier of these two times, earlier of this period. So from 01/01/2023, sorry, in this our case, it will be 2024. So the earlier of the time the person was actually supposed to do the filing, all right, and the range he has is first the 30th, what is supposed to be 30th March, right? 30th March 2024. That is when he had to do the self-assessment. To 30th, or this is supposed to be 31st, right? March, the end of March is 31. So it's supposed to be 31st. So you have 31st March 2024 up to 30th April 2025. All right. So this period, the earlier of this period or the day the person actually filed. All right. So the day actual filing was done. So let me explain it further. The day actual filing was done. So you pick the one which comes earlier. So let's do this illustration. So let's say a company was actually supposed to file this on this date. All right. That is the date they have to file. The deadline they have to file, because you have January, February, March, the first quarter. Now let's say somebody files on let's say 30th November 2024. All right. So the deadline is this. This is the deadline. So you'll be using the earlier of this date, or this one. So the comparison is between these two deadlines. All right. So that is that. The earlier of this day or this day. So in this case, which one will you pick?
30th November.
30th November. So that is that. And when you pick it, you must express it in years. All right. Express it in years. Expressed in years. In years means that you divide whatever month it is over 12, because 12 months makes a year. Let's say, okay, what if the person files the thing, come to file something that he should have filed for his 2024 account here. He filed it on, let's say, 30th June 2025. Which one will you pick between this one and this date? Which one will you pick?
30th April 2025.
Exactly. So that is that. So with this understanding, we just need to go in there and do the calculations. All right. So that is what we're going in there to do. So now, that's the explanation. Now, first of all, let's try with this with these kind of examples. All right. Okay. So we have this simple example, and this one is telling us to calculate the underpayment. All right. So let's work this example. All right, so the example here says that the following data relates to NAB Limited, Lab Limited Tax Affairs for 2018 year of assessment. Now, the tax paid on assessment, you have to listen to it very carefully. Be careful, it's law. Tax paid on assessment. So the tax paid, as you see, the tax paid on self-assessment is 1 million. Then you have the chargeable income. That tells you that the chargeable income is 4 million. That tells you that this tax paid was calculated like 25% on this. So that is what you have for the self-assessment. Then on the actual, the return showed that his chargeable income was 6 million. And so by actual tax payable, which is a 25% in this case, was 1.5. Now, we said that to be able to calculate the underpayment, what do you need to do? 90% of the correct amount. Is that not it? And what is the correct amount here? What is the correct amount in this case?
1.5 million.
1.5 million. So 1.5 million. And then 90% of the 1.5 million will give us something around 1.350. Is that not it? So that is that. Then we, as the law said, we are comparing this one to what he had paid by installment. What he had paid by installment. How much has he paid? According to the question, he has paid 1 million. So when we check the one that he paid, it means that by this computation, his underpayment is 350. So basically, that is that. So that is the underpayment that will be subject to interest calculation. All right. So basically that is that. I hope it makes sense. Now, we move on to, so this is the compounding. I've already explained the variables in the compounding. So what we're going to do is to pick a question straight away and deal with the compounding. Now, watch this. Yeah, we said that the interest is calculated on quarterly basis. Now, look at this illustration. Kofi and Son Limited filed returns for 2017 on 2018 April 30th. So that is the time he did the filing. Now, dealing with, and the following information has been provided. The tax payable, the actual is 200,000. Now, it is the actual we calculate the correct amount, which is the correct amount. And we said that, and if you have the actual that you have, which is the correct amount, so actual tax payable is 200,000. So we said that what you'll be doing is that you'll be calculating 90% of the actual. So what is 90% of the actual?
180,000.
180,000. So we have 180,000. And we are going to compare it to what the person paid. What the person paid. Now the question says that the estimated tax was 100,000. It didn't tell us that that was what was paid, but herein, since we are not giving any payment information, the assumption is that that is what is paid, and we have been given the statutory rate. So if this is the case, let's say he has been paying and this figure. So in actual sense, since we are going to calculate these things on quarterly basis, what we are supposed to do is that this one that he has, we need to divide it over 4. The 180,000 over 4. And what would we get? And his self-assessment that he did and paid, per this question, was 100,000. So that also, we have to do 100,000 over 4. So how much are we going to get? I think since the payment and this thing is okay, looks equal, we can as well divide this side by 4, and each quarter will be 20,000. Do it for this side, let's see, because here will be 25,000, right? So my guess is that here should be 45,000. Is that correct?
Yes, 45,000.
Exactly, so that we will end up with our 20,000. So it means that every quarter, as seen, he has been underpaying by 2,000. Now, if we apply the formula, A is equal to P into bracket 1 plus R over N, NT. Our A will be found by using these quarters. So we have 20,000 into bracket 1 plus, we need to find R. We said R is what? 125% of the statutory rate. So now the statutory rate was given to us as 20%. So 125% of 20 is what?
25%.
25. So that is 0.25 over N. And we know that N is 12 because it's compounding annually. So N again, 12. Then the time. When did he file? Per the question, when was the filing done? He did it
30th
on
April.
30th April. So that is the thing. So we said the earliest of 30th April or the day he actually filed. Here it is equal. 30th April is equal to the day he actually filed. So that means that it's the same thing. Now, if it is 30th April, you have to count from 31st March to 30th April. 31st March of 2017 to 30th April 2018 gives you 13 months. So if you express this over the year, it will be 13 over 2. So if this one will cancel this side, then you work the remaining within. So you'll be kind of having something like 20,000, 1 plus 0.25 over 12 raised to the power 13. So when you do your calculation, what will be A? What will be A? All right, do the calculation and let's see what will be A. Once you find A, you can now deduct the 20,000 from it and know the interest, because interest in this formula is given by is given by A minus P. So that is how the interest is given. All right. So once you get your answer, you take away the 20,000.
It will be 26,140.
140. 26,140 what? 148. Point what? Point
30.
0.30. All right. So that
Yes.
is
7.
basically 37 rather. All right.
Point
So
27 rather.
27.
Yes, yes.
All right. So 0.27. So that is basically it. So you have your amount. So if I now deduct from this one, I know my interest for this quarter was 6,148.27. Now we're going to do same for the remaining quarters. So you find out that your Q2, the same amount was underpaid. You are going to do the same thing. 1 plus 0.25 over 12. 12 multiplied by, of course, this is the second quarter, so 3 has to be out of this 13. So you have 10 over 13. So you go ahead and do it, find the answer, then you find the interest. When you finish, you're going to do Q3, which will be 20,000.
I think it
1
should be 10
plus
over 12.
10 over 12, sorry, yeah. So that 12 will cancel 12. So here too, you have 0.25 over 12 raised to the power 12 multiplying. You take these 3 out, you have 7 over 12. Then the Q3, the last one, the Q4, will also be the amount paid quarterly, 1 plus 0.25 over 12 raised to the power 12 multiplying, so it will be 4 over 12. So basically that is how it works. So here we had interest of 614827. So you work the rest, you get us the interest. Then we total the
Quarter 2 will be 23,105.42.
105.42, meaning
No,
that
that's
the
for quarter
interest
3.
quarter 3.
Yes, yes.
This figure is for quarter 3.
Yes.
So what will be quarter 2?
Quarter 2 will be 24,579.80.
20.
24,579.80.
0.80. All right, so that tells us that we can take those on top.
And
So
quarter
here is
4. Quarter 4 will be 21,719.48.
0.48. So that will be, it's 21, 21,000,
Yes, 21,000.
So that means here will be 1,719.48. So you total the everything, then you find the interest. All right, so basically that's how it works. All right. So let me see if this thing has opened. No, it couldn't open. All right, so that is how you work it. So you can give me the total of everything.
Okay.
So let's see the figures that I have in here. All right, there's a little slight difference, maybe due to approximations. And so you have it. All right. So when you finish, we will do the second question.
The
Question
total
2.
will be 15,552.97.
All right. So basically, that's that. So that's how you calculate the interest. All right. So that is it. Okay. So in this question, we were not giving the, what do we call it? The payments. We assume that the self-assessment quarterly installment was the payment. So in the next question we're coming to do, we are actually giving the payment. So that is that. But there is something about the payment if you saw what we did, we actually found out that it was payment by installment. Payment by installment. So that is the key thing. It is his installment payment. Now, in the law, GRA, when we say payment by installment, then it means that it is the quarterly installment payment that you did, that you went to do in terms of your cash. All right, so that is that. Plus any withholding tax that was remitted on your behalf. So if a customer deducted withholding tax from you and remitted it to GRA, it is seen as part of your payment during the quarter. All right, so that is that. But the payment of cash must be prior that quarter. So prior the quarter. I'm going to explain it further. So that is that. Now, so that is for self-assessment. Self-assessment. But when we are doing our penalty calculation, if I paid in that quarter, that is what I paid in that quarter. But in the self-assessment, we look at the price. All right. Now I'm going to show you how this thing is done in a question, in this question. Because when we talk about payment, for as far as payment is concerned, if in Q1 I paid, that is my payment in Q1. So when I'm doing my penalty calculation, that is what I will use. But in self-assessment estimation, this is how we look at it. So I'm going to use this question to elaborate on it. Now look at this question. We have Diaz, who prepares financial statement from January to December each year. And this is the self-assessment. You can see that the self-assessment, he estimated to be paying 500,000. So as a matter of fact, that 500,000 could have been divided by 4, and so we will know how much he's supposed to pay. Let's try it. 500,000 divided by 4. How much should be that?
125,000.
125,000. Each quarter, that is what he's supposed to do. But herein, we are told that his tax credit is 350, and the question says the tax credit was via cash payment, which was made up of the following. So instead of this guy even paying 125,000 every quarter, he didn't. Quarter 1, have you seen what he paid? Quarter 1 is 100,000. Quarter 2, he didn't pay anything because quarter 2 ends in June. This one is July. And September 2 is quarter 3. So in quarter 3, he rather paid 200,000, and in the last quarter. So he didn't even pay the tax according to his own self-assessment estimate. All right, so that is what happened. Now, if we are now going to, let's leave the A side of the question first, because I'll show you how you do the self-assessment. If we want to use this information to do the penalty, the interest calculation, this is what is going to happen. We know that he has been paying this. What is 90% of the correct amount? You see, instead of paying this one, he was paying this. What is 90% of the correct amount? The correct amount is the actual tax payable, which is given here as what? 800,000. So what is the 90% of the actual amount?
720,000.
720,000. So that is what you have in there. See, under normal circumstance, this 720,000 is what should have been. And so each quarter, how much should he have been paying?
350,000.
Each quarter. Is that it? 300 and... If you divide this by 4, what do you get? I don't think it's 350,000.
Okay, it's 180,000.
180,000.
Yes.
So if you divide this by 4, you have 180,000. So this is what he should have been doing every quarter. But if we pick Q1, for example, instead of 180,000, how much did he pay? Just 100,000. That tells you, and don't forget, the law said it is the difference between, it's the law, it is not me, it is the law. The law said that it is the difference between the 90% of the total that would have been paid by way of installment during the year of assessment and the amount of income tax paid. So that is what we are doing. That is what we are doing. So you have to use the paid. It is just that when you are not giving the paid, you assume that what he estimated is what he paid. So now this is what he paid, meaning that he underpaid 80,000. And that is what we are going to use to calculate his interest for Q1. Then we come to Q2. He should be paying 180. He paid nothing in Q2, as we can see. Then in Q3, 180,000 that he's supposed to pay, he paid 200,000, as you can see, these two. And that gives him a negative 20. So he overpaid. So here, since he paid nil, his interest will be calculated on this amount. And here he has overpaid, and this, there will be no interest because he paid. Now, in Q4, he is supposed to pay 180,000. He paid just 50,000, but he has a credit of 20,000. So you have to benefit him for his credit, and meaning that in this year, in this quarter, his underpayment is what? 110,000. So it is these figures now you are going to use to compute the compound interest. So the same thing, you've been given the statutory rate, just as you did. It's just that when you pick Q1, you're going to do 80,000. And when did he file? So you will need that when the person filed. It says the consultants of theirs filed on 31st April. That should be 30th April of the following year. We don't have 31st in April. So that is that. So that this one too, he failed to file throughout the year till the end. So here we will have 1 plus, and we've established that 125% of 20 is 0.25, right? So that is that. You have 12 here. So the first quarter will be 12 months multiplied by 13 over 12 months. So when you do it, you find your figure, then you find the interest. But when you are doing Q2, you're going to use how much? 180,000. That is what he didn't pay. The same thing over 12, 10 over 12. Then you go ahead. You do Q3. Q3, there is nil. You can't charge him penalty. Q4, interest. Q4 will be calculated using 110,000 into bracket 1 plus 0.25 over 12. And here we have 12 multiplying 4 over 12. So that is how you go around and do it. So as for the mathematical aspect, I will leave it to you. When you finish, then you total. So you can do it at your end, and that is how it will be. All right. So basically, that is that. Now, so that is how you go ahead and do. So now you have to always find the difference between the 90% of the correct amount divided by 4 and compare it to how much the person has been paying in each quarter. All right, so that is how you do it. So you find the 90% divided by 4, find the amount that he has also been paying, all right, and compare it on quarterly and calculate the interest. All right, so basically that is that. Now, I just wanted to show you how we do self-assessment, because in this question, for example, we were asked to do self-assessment. So just a quick one on self-assessment. In the self-assessment, I said that you will need the chargeable income. You calculate 25% of it, and you divide it by 4, and you go ahead and do it. Now, this is what the law aids us to calculate it. So the law says that we should use A by B over C. This is the methodology. Now, the law says that what is C? It defines C for us. So, and it defines A for us. Now, this is what it says A is. A is the current estimated tax payable by installment, the current one. The current one. And current is a key word because somebody can be revising his estimate. So whatever estimate that is there is what you use, the current one. So be careful, the current one. All right, so that is that, the current. Then C is the number of period remaining, including the current installment, also the same. So when we start the mathematics, you get more understanding. It is also the current. So if I'm in February,
I think
my
the phone on
current.
the board, I think it should be A minus B rather.
Oh, come again. Yeah, sorry. It's A minus B. Yeah, that is it. That is A times B is what we actually use to calculate employment income. See, yeah, so that is that. So A minus B over C. All right, so basically that is that. All right, so that is what you see. So as you see it here, exactly the same. That the problem is the B. The B, you have to be very careful with the B. All right, because if I'm in February, my C is 4. If I'm in, let's say I'm in April, my C will be 3. All right, so the remaining quarters, all right, ahead of you, the remaining quarters ahead of you, including where you stand. So that is where he said, including the current installment. All right, so that is that. Now, what's the B? B says that B is the total tax paid by the person during the year. So that is that. Total tax paid. Total tax paid by the person during the year before the due date of that current installment. That is the powerful part. Before. So whatever payment you are going to include in that quarters analysis, you must not include payments within that same quarter, but every payment that you'll be including should be payments that were done before. All right, before. And it says that this includes tax paid through previous installments. So those ones you paid previously, tax withheld, tax paid by withholding agents or persons as a withholdee. So like the one that I was explaining, so the tax paid in this self-assessment calculation will be the one you paid before, plus those ones that some withholding tax agents have been remitting from your payment. So that one is no before. That one is current. It can be before and current. So it didn't limit it to before. It says that tax paid by withholding. So it means either it is before or it is current. All right. So basically that is that. So you know C. So that is basically. So if we look at our example, for example, this one, where the tax payable was 500,000. So this one will say the current estimated tax payable, estimate, not the actual. So we picked the first 500,000 and we look at the payments that came. Which one was done before that first quarter? None, because the one that is paid here is within the quarter. And since it is via a cash payment and not via a withholding tax agent, that is it. We can't include it. Because according to the law, that payment that is via cash must be a payment that is previous. Here, this is the first one, and there is no previous. And that is why you see -0 here. All right. And the remaining period counting from there is 4. So you have 500 divided by 4. But when you go into the Q2, you have the 500. And in Q2, there is 100, which is a previous, in the previous quarter. So now you can deduct the 100 and divide it by the remaining quarters, which is 3. All right. Then when you come to Q3, you see Q3, there was no payment made in Q2. So the only payment that will still be standing will be the 100,000. That is the only previous. So that is why you see only 100,000 deducted and the remaining is 2. And when you come to Q4, this is the payment that was made in Q4, but we can't include that payment because it is cash payment. And therefore, the law says that if it's about cash payment, then we should always consider only those ones that are previous. So these 3 becomes previous to the Q4. So you deduct 1, 2, and 3, and the remaining current timing is 1. So basically that is it. But be mindful that if the person had changed his assessment, we call it revised assessment on this quarter, let's say Q2, we would have replaced the 500 with the revised one. So whenever it is revised, also use the revised figure, because when we read this B, where is the A, we said that it is the current estimated tax payable. All right. So if you revised it, then it means that is your payable. Then you deduct all those you have paid previously. All right. So basically that is that. So that is how you do an assessment. We work this one. This is the one that I'm expecting that you do at your end to arrive at the answer. So we pick the last question here. We pick the last question here. And as for the remaining interest, it's very easy. We just look at it and theoretically, and we go. All right. So let's work this one together. Let's work this one together. All right. So now, looking at this guy, he prepares his amount 31st December each year, his account. And we are looking at his accounting information for 2020. And this is his self-assessment on February. So he did it in time. He filed it in time. So he filed it on 1st February. And he revised it on this date. So that is 8 July will be in the 3rd quarter, right? And according to the return filed on this is the time he filed his return. You see, now, when I was doing the analysis for you, I made mention of the fact that somebody has 31st March 2024 up to 30th April 2025. Now, what I was trying to explain to you is that this is the period. He has this self-assessment. This is the end date for his self-assessment. This is the end date. Any other day he's doing that is a delay, and therefore there will be what we call penalty, right? If you don't do it on this day, there's penalty. When it comes to your final assessment, you have this one, this date to do it. That is that. So we use this one for self-assessment. This is the self-assessment deadline. And this is the final assessment deadline. Of course, you can write to GRA for an extension. We will learn it in tax planning. All right. So final account filing date. All right. This is what you have. Now, if I therefore file my final account, some people are efficient. They can file their final account before this date. And that is what I was trying to explain to you, the earlier of the two. So if he files it before, and the example we did initially, in reality, it doesn't work, but just academic, all right? Like this example, the one that I showed you when I was starting. In reality, it won't happen. But in academic, I mean, it's a question, so we can just put it there. So this one, like I was saying, but particularly this one, you do know that the year has not ended. So it will be very difficult for you to file your final account that you are supposed to do on this date at this date. It's very difficult because the year has not ended. But this one is possible because you can delay. And so therefore, between these days and these days, you always pick the earlier one, but no question will give you something like this. It's either the question will give you to the extent that it will be something like this. It's either the person filed it on exactly the exact date, or he went over it. But for academic purpose, I can decide to give you this because that is that. So the day the person filed, you start counting from this deadline of the self-assessment, I mean the provisional self-assessment. So that is where you start counting from to the day he actually filed. So it's either he will file on the deadline or on the earliest of the two. All right. So that is what we are trying to do. So if you look at the question that is in front of us, our last question here, what you see in here is that you see, this is the He has 31st March to do his self-assessment. He did it on 1st April, so he's cool. He has met every deadline. But this is the date he filed his return. You see, the earlier, so you see, it's either 30th April or earlier, or maybe after the 30th April. But you see, he filed earlier. This is 30th, 31st March. So if you count the thing, you will see that you will have 12 months instead of 13 months. So now let's look at it. If you are going to look at how we do our self-assessment, let's check the self-assessment. And in this question too, I think that we weren't giving the paid. So it means we will assume the self-assessment as what he was paying on quarterly basis. All right, so that is that. So if we take Q1, we said that we will need A, so the formula is A minus B over C. A is the actual tax payable. So the estimated tax payable, sorry. So if this is the estimate he did, this is it. Then he has estimated that he will be paying 100,000. So we will do 100,000 minus previous amount paid. We don't have any previous amount paid inside this. So it's 0. And so we will divide it by 4. And how much would that be? I think it's 25,000, right? So that is what will happen. That is what will happen. So this one we weren't giving payment. So we are assuming that whatever he did here is what he paid. All right. So that is that. So therefore, when we come to Q2, it will still be 100,000 minus. Now, what is the previous? You see, we are in Q2. The previous payment is assumed this. And this means that we assume that he actually paid this money on 31st March of this quarter. So if he did, then it means we are going to deduct that 25,000. And here will be over 3. And how much would that give us? I think that will still be 25,000. So that is that. And we assume that this one too was paid by 30th June. All right. In that case, when we are doing the Q3, he revised his assessment, which means that he has said that his estimated tax payable now is 120,000, and we will deduct what he has paid previously, and that will be this 25,000 he has paid and this 25,000, making it 50,000. Then the remaining quarters are 2. So that is like 70,000 divided by 2. That is like 35,000. We are assuming that this is what he also paid on September 30th. Then Q4, now this is the new revised figure. So we will keep using the revised figure minus 50,000. So this one, the 50,000, I as in this plus this plus this. So in all, that will be like 85, right? 85,000 divided by 1. And that is also 35,000. So here we are assuming that this is what he has been paying on quarterly basis. Now, if we want to do the underestimated or underpayment of tax, we said that we need to do 90% of the correct amount. So 90% of the correct amount, what was the correct amount? This actual tax payable was 160. So 90% of the actual tax payable, 90 will give us what?
144,000.
144,000. So this is the actual. When we do how much this goes into in terms of quarterly, how much will it be? In terms of quarterly.
36,000.
36,000. So if it is 36,000 you're supposed to pay each quarter, then when we pay quarter 1, we realize that instead of paying 36,000, we saw that quarter 1 he paid 25. So we'll be calculating our interest using 11,000 difference. So you fix it into the formula. All right. Then quarter 2, instead of paying 36,000, we also saw that it was 25,000. So that is that. You will use 11,000. Now, the quarter 3, you see, we saw it is 35,000. So quarter 3 here will be 36,000 minus 35,000. So we'll be calculating the interest using just 1,000. I think quarter 4 is the same. All right, so that is that. Also 1,000. But when you are doing it, you need to be careful because, for example, if you pick quarter 1, that you are using 11,000 into bracket 1 plus 0.25 over 12 multiplied by raised to the power 12. Here, the figure that should be here, he did the earlier, he did at 31st. So you will count from the 31st March to 31st March of 2020 in this case to 31st March of 2021. And I seen you, so you basically start from 1st April of the previous year, and that will give you 12 months. So here we'll cancel here. So 12 will still be the standing. So if you are doing Q, so Q1 goes like this. Q2, this side will now be 12 raised to the power. If you take 3 out, it will be 9 over 12. So you move on. Quarter 3 will be minus 3 will be 6 over 12. Then quarter 4 will be 3 over 12. All right. So that is how it will be. And now, if you see it here in your manual, this is how it will be. So you see that this one is raised to the power 12 over 12, 9 over 12, as you can see. The next one is 6 over 12, then 3 over 12. So when you compute it, you will see this is how it ends. All right. So basically that is that. So when you get your manual, you just go over it. All right. Now, a quick one. So for the others, it's just simple. And I think that when you go through it, you will be able to. This is the most important part that is examinable all the time because given the calculation. Because the others that says the section 71 that is about interest on failing to file your tax. Interest on failing to file your tax. So here we are looking really at kind of the penalty concept. And the interest part is this. It says that this section states that if a person fails to pay tax on due date, he is liable to pay interest, which is 125% of the statutory rate compounded monthly applied on the outstanding amount. So here is not an underestimation. If you fail to pay it on time too, we will be calculating the penalties. All right. So basically that is that. It says that it also classifies that the adjusted assessment is payable on the original assessment due date and any other tax that is payable on the due date specified. Additionally, any extension or suspension granted are ignored. So if you are calculating your delay, when it comes to the interest, your extensions are ignored. All right. So basically that. Now, to explain this further, it says that finally it specifies that withholding tax agents cannot recover interest from the person subject to withholding tax. Now, watch this. In the law, when we say currency point, it's 1 cedi. When we say penalty unit, it is 12 cedis. Now, watch this question. It explains it for you. It says that a pedantic company, a trading company, paid taxes it withheld from supplier on 26 February 2020 on May 2017. You see, when it comes to withholding tax, you see the tax he withheld on this date, he should be filing this tax per the law as we learned the last time. He should be filing it on 15th March 2020. 15th March 2020. So that is when he should be filing it. Because the law says that for withholding tax, if you withhold, you must pay on or before the 15th day of the ensuing month, which is the next month. So clearly, and look at the date he filed. Clearly. So I told you that there is penalty and there is interest. So if he filed 26 according to the question, if he filed 26 May 2020. Then two things has happened. One, he delayed in filing, which is a penalty case. Then since he didn't file, interest will accrue. So now how do you calculate it? We say that for the penalty, we say that you will count the number of days. So how many days did he miss? How many days? So from here to here, how many days? So April is how many days? 30 days, right? April is 30 days. 15th of March means that he has another 15 days. 15th of March is another 15 days. Then up to 26th of May is another 26 days. 15th of March, no, that will be 16, right? Because March is 31. So that is that. Then here he has 20, is it 25 or 26? Because he filed on the 26th day, right? So 25. I think that will be it. Is that it? Yeah. So,
Yeah.
so yeah, kind of. I think that is what will happen. So you count the days. So the remaining 16 days in, I think that will be 16 days in March, right? Then, what do you call it? 30 days in April. Then 25 days. So let's count it and let's see. So
That would be
these are
71.
the total is what?
71.
71 days.
Yes.
All right. But I am having these days here. Oh, okay. We didn't check it well. Oh. This one is 2017. There's an error in there. There's an error in there. It has to be checked because if the withholding is this, he filed it here. So I think this thing should be changed to 20. It should be changed to 2021. All right. Because this date is behind. It must be changed to 2021. That is what will happen. All right. So if it is changed to 2021, then I think when you count the days, you'll be having these days that is in the solution. So it's something you have. It has to be 2021. But you said when you did it, you had how many days? Per this one is how many days?
So 71 plus 365 days is 436 days.
Exactly. So you clearly see that it is there. So you said here was 71, right? So if this one was in the next year, then it means we will need 365 days. All right. So that is that. And 2021 will not be a leap year. So it will be 365. So that is why you see 436 in the solution. All right. So that is that. So in your manual, you can correct this one to 2021. All right. So that is that. So that is it. So that these days, these are the days he has missed. The very first day is 500 Ghana cedis. I told you that. Then the remaining 435 days will be multiplied by 10 Ghana each day. So that is that. So here will be 4350 plus this. So that is what you see here. All right. That is what you see here. So every day, the first day is 500 cedis. Then every day on toward is 10 Ghana. So that is that. But you still have interest to pay because the money amount involved that you should have been paying was 20,000 and the BOG rate is there. So you'll be doing you do 125 percent of the statutory rate. So here the thing was given to you in days. So this is how your formula will be. You know, your formula is 1 plus R N T. So here we have P here. The amount involved was 20,000 per the question. 1 plus R. Statutory rate was, according to the question, is 25%. And you told me that the statutory rate, when it is 25%, you gave me 31.25. You remember? So 0.3125 before.
Yeah.
So here will be 12. And so here will be 12 multiplied by the days he has missed is 436 days expressed on 365. So it means this side too should be 365 because 12 months means 365. So or you can just leave it as 12, all right, so that you can actually express it well. So you divide this one and multiply by the 12 year. So you can actually have so whatever the answer that we got here is 289. If we take it from, I think the figure here is actually 200,000. So if you take it from your 200,000, you realize that you are paying an interest of 89,000. All right, so 89,080. So if you delay, there is penalty and there is interest. The interest is the same as what you did. It's just that here you will not be doing it in quarterly. All right, because this is not self-assessment that you are supposed to be paying quarterly. All right, so that is what you do. So you express it in the same formula. All right, I hope that when you get your manual, there is another one in here you can apply on. So here, this one, I think that he did an adjustment. So when you get your manual, you go through it to find the solution to that. All right. And the rest is theoretical. I mean, you just go through it. If a person does not keep the required document, he may pay a penalty. And the penalty is either 75% of the tax owed, or if the failure is deliberate. And if it is not deliberate, then so the law says that if the failure is deliberate, you'll be paying a penalty of 75% of the amount or lesser of that amount and 25 currency points. I told you currency point is how much? 10 Ghana cedis. So it's either, if it is not deliberate, it's either you pay 250 Ghana cedis or the amount itself. All right. So that is that. So these are the theory bits, but those ones that are mostly examinable are the ones that include the calculation. That does not preclude you from learning these ones too. All right, so these are the theoretical penalties that you go through, and well, those ones when you read that will be all. We've already done the collecting the tax assessed, and I want to mention this one because aiding somebody to defraud GRA is just as committing the crime. In fact, your own is even worse. So he said that a person who knowingly or without reasonable excuse aid, abet, counsel, or induce another person to commit an offense under section 78 to 84 is liable to pay a penalty of 100% of the tax for. So that is that. So we, the consultants, if we induce somebody to actually defraud GRA and it's found, we, the consultants, we are at risk. All right. So that is that. We are at risk. And so if you want to desist from this, that's what we learned the other time, that if you are filing for a client and you feel like there's certain things that you object to, once you finish signing, state your objection to the thing. All right. So basically, that is that. So this is where we will wrap up this. The next time we meet, we are going to start tax planning. But I don't know if you have any question at this point, other than the fact that I will upload the lecture right now on your channel. If there is any question, let me.
Oh, no question.
All right.